When you hear Loretta Mester and Bullard come out and say, yeah, maybe we should have gone even higher, do you think that that's sort of a litmus test for how the market would react?
Well, I think that there are two narratives right now, and they're backing that first narrative, which is that inflation is sticky. And if inflation is sticky, then the Fed has to do more in order to battle inflation, which would bring on a harsher recession. The markets are warring with that and the soft landing scenario. And those are two very opposite camps, but honestly, I'm landing in the soft landing scenario, which is not not always the prevailing view. But if you look at the data, it supports it.
Why? What data are you seeing that makes you think, hey, we might come out of this okay?
Well, a few things. One, if you look under the hood of CPI, all of the raw goods type, like, goods prices, those kinds of prices are all falling. The only price sector that's rising right now in CPI, the component is services, and services is driven by wages, not by oil. You see oil falling today, too. The other thing I'm looking at is the difference between PPI and CPI. If PPI is the price of your inputs and CPI is what you can pass through to your customers, there's actually still a gap there, which is to suggest that companies are doing fine passing these prices through to consumers. And if that's the case, margins are still healthy, right? Wages, on the other hand, are the kind of inflation that causes greater demand. In the end, there's a productive form of that, and a little bit of that is good. Too much of that is bad, and that, I think we have done quite a bit with regard to Fed movement. But it would suggest that all of this resetting of wages is, in fact, leaving the consumer in a healthier place. And there's one last piece, and that's that most of the workers who left in the 55-plus cohort of workers have gone. And in fact, there's a worker shortage right now, and you can see that in the number of weeks that it takes for full-time full-time workers to find a new job. And that number is actually falling, which is to say that people are finding jobs faster and faster.
And more workers is a solution that requires attention from Congress, attention from local and state leaders, and it's a long-term challenge, not something that we can fix with one magic solution. That being said, all of this talk of the tight labor market and whether the rate hikes keep coming, we've already heard from Jerome Powell that it's going to be a bumpy road to reduce inflation. Are you expecting the same for the markets?
Well, yeah. I mean, I think that what you're seeing right now is you're seeing a crimp in you're seeing a crimp in margins because wages are going up, and that does tend to be sticky. However, I think that what we're doing is we're resetting as a market. We're basically saying maybe those high margins are not normal. Maybe the right number for margins is a bit lower. Having a healthier consumer is not a bad thing. But the markets themselves are going to have to keep re-rating down. That, in combination with the fact that nobody's expecting the Fed on the other side of this to do a big interest rate cutting cycle. And if that's the case, then a lot of the multiples that have gone away, they're gone.